Pratik Gupta joins us, CEO and co-head institutional business with Kotak Securities. He joins us live. Pratik, good morning. Thank you for joining us. It's been a good year so far, Pratik, especially if I look at the market from the month of April. What is driving the market? Is it liquidity or genuine turnaround in macros?
Hi, good morning, Nikunj. It's a bit of both, actually. One is obviously the big turning point came when expectations globally started building up that the global interest rate hiking cycle is probably nearing its peak. And obviously, June was the inflection point. And this week, as you mentioned earlier, we have the Fed, which will likely hike rates perhaps for the last time or maybe one more time at best. So that's the big driver of global flows into risk assets like emerging market assets in particular. And India has been a beneficiary of those assets. In fact, as you know, it's been the strong FPI flow which has been driving our market. But I would just like to clarify that, it's not just India which is doing exceptionally well or doing well. We always look at China versus India. But in the US, for example, our Nifty is up only 9%, but the S&P is up 18% year to date from January till now. The Nasdaq is up 34%. Japan is up some 24%. Korea is up 18%. Taiwan is up 20%. Even smaller markets like Vietnam is up 44%. Sri Lanka is up 30%. Even Pakistan is up 13%. It's a broad-based global equity rally, and India has been a beneficiary. So that's point one. And second, I think what's also helping India in particular is also our own macros have turned out to be quite decent. The current account deficit is okay. Inflation is under control. Corporate earnings growth are holding up. At Kotak, we are expecting about a 15% earnings CAGR for the Nifty in FY24 and FY25. And so far, the earnings seem to be by and large okay. There are obviously individual companies doing a little bit better or worse, but by and large, it's been quite okay. So what's happening is we are seeing a global equity rally. India is also participating. The local flows remain strong. Monsoons was a big risk factor, but that seems to be fading. It seems to be going well. So by and large, it's looking good for the time being. Obviously, valuations are getting a bit expensive. So let's see how long this lasts.
Watching the show, what should they do? That's a simple advice.
Sorry, can you repeat the question?
For those who are watching the show and if they want to understand the market from your lens of valuation as well as flow, what should be the basic approach?
Well, I think as always, equities is a long-term game. In the short term, clearly we are getting quite concerned. We are getting cautious. We think the market has entered the expensive zone. If you look at the Nifty, for example, is trading at 21 times FY24, 19 times FY25. We are at almost a 70% premium to the MSCI Emerging Markets Index, and typically the range has been 20% to 80%. So we're probably at the upper end. There's still perhaps a little bit of overshoot possible over there. Or if you look at our market compared to bond yields, earnings yields are roughly 5% versus bond yields of over 7%. So whichever metric you look at, we are in the expensive zone. So in the short term, anyone who has a short-term investment horizon, they should be a bit cautious. Although, as we've seen many times in the past, you do tend to get valuation overshoots. So now if you're investing now in the short term, you're playing for that valuation overshoot, which is always very risky. Longer term, I think the outlook is more attractive. If you have a 3-4 year investment horizon, we think the corporate earnings growth cycle should remain quite strong, especially if the private sector capex cycle picks up. So we think you'll see 15-16% earnings growth over the next 3 to 4 years. And even if you have a modest de-rating, even then, I think the returns can be quite attractive. So it depends on your investment horizon. Short term, we would be cautious. Longer term, we are still quite optimistic.
Let's talk about the near term then, Pratik. And what is it that you made of some of the banking earnings that we've seen? Does it seem like the margins are peaking out? At least, some of the managements pretty much categorically said that this is the peak of it in the near term.
Yeah, yes, we do. We also believe that margins are peaking out, and it's tough to expect the same NIMs to continue going forward. But equally, the question is, are you expecting a very sharp decline in NIMs? Then the answer is no. We think there will be a gradual moderation, not a very sharp decline. And I think for the banks, the bigger point is the loan growth cycle is still looking very strong. Loan growth, on average, we should be 15 to 20% and may even accelerate in the coming quarters. And equally, and is the credit cost part of it, which we think will remain quite low even in FY24 and perhaps going into FY25. So banks are actually our top sectoral pick at the current valuations, both from a fundamental business outlook perspective as well as from a valuation perspective. Banks still look good. They're in the sweet spot where credit growth is picking up. The NIMs are moderating, but very slowly, and credit costs are likely to remain low for the next 1 year at least. So we like the banks. Banks are actually our top sectoral pick right now.
Pratik, the other sector, of course, which has really been the talking point as up until Friday was IT. While TCS, HCL Technology and the likes were okay, but I think the shocker came in from Infosys. Did you anticipate this kind of a commentary coming in from them?
Not the commentary, although we have been expecting that things will slow down in the September-December quarter, perhaps even the March quarter. So we were anticipating a slowdown in the business. The guidance obviously was a bit of a surprise. You saw the stock reaction thereafter. But in general, we have been expecting that the main market for these companies is the US, which has been expected to slow down. Discretionary spending has been coming down. So obviously the decision-making timelines are getting elongated. Discretionary spending is coming off. To that extent, clearly the outlook would not have been as strong. And we have been a bit cautious on the sector in the past for the last several months. And even now, I would say we're not totally, out of the woods as yet. Things can get worse if the US slowdown worsens. Although increasingly, it's looking like they might just be able to get away with a very mild slowdown or a mild recession. So in which case, we'll probably just hover around the bottoms for the time being. But to expect a quick recovery in this sector is unreal. I would just also caution that it is the mid-cap IT companies where I think one needs to be more careful of, where they're more vulnerable to a slowdown in discretionary spending. And also the ERD companies, which tend to get a bit more impacted when there's slowdown in discretionary spending. The large caps will still do relatively better, but in general, we would stay away from export-oriented sectors.
Pratik, hi. Wanted to also get in your thoughts when it comes to the entire auto space. It's going to be in the spotlight, especially this week, with a whole host of numbers expected. Do you think that given the kind of fury that we've seen on the upside or the kind of strong run-up, that now the auto companies will have to go above and beyond when it comes to their numbers being positive?
Yes, absolutely. To sustain these valuations, we think the numbers will have to be something quite dramatic. We need to see a very strong pickup in overall industry demand. Our concern on the auto OEMs is more the increasing competitive intensity, both from the existing listed players as they are, as well as a lot of the unlisted players, both in the two-wheeler and the four-wheeler space, where the Japanese, the Koreans, etc., and in the EV space, for example, in the two-wheelers, you have some Indian folks as well. So competitive intensity is increasing very, very dramatically, and we think the market is being overly generous in giving these kind of multiples. They're simply extrapolating that this is just a repeat of the old cycle where industry demand picks up and these companies again start delivering great volumes and free cash flows thereafter. But the change this time around, in our view, is that competitive intensity is going to be very, very different. Some of the incumbents, their product pipelines are not as strong, and you therefore, as a result, you may not see the same kind of sales or margins, and therefore the free cash flows going forward. So valuations right now are going back to the old. In fact, they've gone above the past multiples. So we are cautious on the auto sector.
There is a binge in luxury cars. There is a change in SUVs. There is a strong uptick in CVs. If I look at the credit numbers which banks are reporting in terms of vehicle financing, all of them are indicating the demand is robust. So while historical valuations may not be on your side, some would argue and say that history is history and money is not made by looking at history.
No, that's true, Nikunj, but also some of these data points, they may not necessarily be pointing to the listed companies being the beneficiaries. A lot of the demand is coming from the two-wheeler EV OEMs, for example, or from the Kias and the Korean players in the four-wheeler sector. The CV cycle, yes, there we are slightly more positive compared to the two-wheelers or the passenger car segment, mainly Maruti over there. But the point is, demand is definitely picking up. We're not disputing the demand pickup, and the monsoons have been good, so we could probably see a good rural pickup as well. But I think we're questioning the longer term outlook for these companies, given the likely increase in competitive intensity with more players, with electric vehicles coming in, a big disruption coming in over there. Their incumbent legacy portfolio business cash flows potentially at risk going forward. They'll have to cannibalize that to grow the EV segment. So in that respect, therefore, giving the same kind of valuations, we are a bit nervous. So we are staying away and recommending investors to stay away from the auto sector.
All right. Appreciate your time. Thank you so much for joining in and sharing with us your thoughts on individual sectors as well as the markets as a whole. Just checking